You've been Wall Street's prey for too long. They hunt you with high fees and complexity designed to keep you confused. But the best investors, Buffett, Lynch, Greenblatt, they hunt differently. Buffett turned $10,000 into $37 million. Lynch averaged 29% over 13 years, and Greenblatt 50% over a decade. They have a proven system. 7 years ago, I was exactly where you are. Scared, confused, without a clear path forward. Then I discovered their hunting system, and today I'm going to show you the exact 5 steps so you can transform from being Wall Street's prey into an apex predator. Let's go. The first step is scout for prey. This is where you find investment opportunities. But here's what separates apex predators from the herd. They don't hunt where everyone else does. Warren Buffett puts it simply: be fearful when others are greedy and greedy when others are fearful. So where do you actually scout? Look for stocks that are little known or not fully understood. Small companies that Wall Street doesn't cover. Spin-offs that get dumped by forced sellers. Look for stocks that are controversial, unsexy, or scary. When everyone else is running away, that's where value hides. Look at the 52-week lows. Not because the stock price is falling, but because that's where you find companies where the business is selling for less than its value. Howard Marks, who turned $10,000 into $2 million over 31 years, says it best. The greatest opportunities for gain come from things that are fundamentally questionable on the surface, deemed inappropriate for respectable portfolios, unappreciated, unpopular, and unloved. Peter Lynch found some of the best investments from looking at everyday life. He noticed that his wife loved shopping at a store called The Gap. He researched it and it became one of his best performers. This is critical. If you're always scouting for prey where everyone else looks, you're going to find stuff that's already been claimed. The market is mostly efficient. That means obvious bargains are snapped up quickly. Your edge comes from looking where others won't or can't. Apex predators know that the best hunting grounds are the ones that everyone else avoids. Now you know where to hunt. But here's the problem. Even in these overlooked hunting grounds, 90% of what you find will be garbage. Dying businesses, value traps, companies that deserve to be ignored. So how do the apex predators separate the winners from the losers in minutes, not months? That's step 2. Step 2 is separate from the group, and this is our first pass filter. Joel Greenblatt, who turned $10,000 into $500,000 in 10 years, didn't waste time on mediocre businesses. He had a system to quickly identify which opportunities were worth stalking. You're looking for 3 things. I call them the 3 M's: mastery, moat, and management. First, mastery. Can I understand this business? Is it consistent year after year? And if you can't predict with certainty what this business will look like in 5 years' time, move on. Charlie Munger expressed, if it requires a spreadsheet or a calculator, it's too close. The best investments are obvious. Second, moat. Does this business have a competitive advantage that keeps competitors out? Buffett calls this having an enduring moat. Think Coca-Cola's brand, Amazon's pricing advantage, and MasterCard's toll bridge on payment systems. If the business has no moat, its competitors will eat its lunch. Skip it. Third is management. Can you trust them? Warren Buffett looks for 3 things in management. He wants them candid, aligned with shareholders, and rational with capital. If the CEO owns barely any of the stock relative to their net worth, that's a red flag. They don't have any skin in the game. If management hides behind accounting tricks or excuses, that's a red flag. If they're making terrible acquisitions or they're buying back stock overpriced, that's a red flag. And here's why this creates massive returns. By filtering out the weak prey in minutes, you save thousands of hours. Professional money managers waste months analyzing garbage. You won't. You'll focus only on businesses that pass these 3 tests. Seth Klarman, whose hedge fund turned $10,000 into $13 million over 41 years, says it perfectly. Investors who confine themselves to what they know, as difficult as that may be, have a considerable advantage over everyone else. This is that advantage. Now I just walked you through the 3 M's: mastery, moat, management. These are the filters that legendary investors use to separate winning stocks from losers. But here's the thing, watching this video gives you knowledge, but applying it gives you results. And most people will never bridge that gap. And that's why I created a free 7-day stock investing challenge. I built this because I wish it existed 7 years ago when I was first starting out. In this challenge, I'll walk you through exactly how to apply this 5-step framework. So you can pick winners, avoid losers, with less effort in less time. It takes less than 20 minutes a day. No prior investing experience required. By day 7, you'll put everything you've learnt to the test, analysing one of Warren Buffett's greatest investments to see if you can do the same. This is the same strategy Warren Buffett used to average 19% returns over 58 years. Howard Marks, 18% over 20 years. Peter Lynch, 29% over 13 years. Joel Greenblatt, 50% over 10 years. The link to join the challenge is in the description. If you want to work with me directly and get the fast track on those results, there's also a link down there for that as well. But whether you go solo or work with me, either way, it's the same. You need to take action because knowledge without action is just entertainment. All right, let's keep going. Okay, you found a business that passes your first filter. It's understandable, it has a moat, management seem trustworthy, but you're not buying yet because even great businesses can be terrible investments if you pay too much. So you need to go deeper. You need to stalk your prey. Step 3 is stalk the prey. This is your deep dive. Apex predators don't rush. They observe, they learn patterns, they wait for the perfect moment. Here's what you do. Read the last 3 annual reports. Skim through and read the parts that matter most. Read the shareholder letters. Does management speak openly about any failures? Or do they hide behind technical jargon and excuses? Look at the financial statements. Are gross margins improving or declining? Compare that with their competitors. Read their annual reports as well. Who has better margins? Who's gaining market share? Peter Lynch did this constantly. He'd visit stores, talk with customers, and call the company. He wanted to know the business cold before he invested. Here's the key. You're looking for consistency. Has his business produced similar results year after year, or is it all over the place? Warren Buffett says, you want to buy stock in a business that's so good that an idiot can run it, because sooner or later, one will. If the business only works when everything's going perfectly, it's too risky. This separates you from 99% of investors. Most people buy on headlines or tips from friends. They never read an annual report, but you will. Because you've done your homework, you'll have conviction. And when the stock market drops 30%, which it will, you won't panic sell. You'll know the business. You know the price drop is just Mr. Market being irrational. That's when apex predators add to their position. All right, you understand the business, you've confirmed that it has a moat, management is trustworthy, the financials look strong, but there's still one critical question. What's it worth? Because here's the truth, even a great business can be a terrible investment if you overpay. This is where step 4 comes in. Step 4 is size them up. You're determining what the business is worth and what you're willing to pay. Howard Marks teaches this. Investment success doesn't come from buying good things, but from buying things well. And here's the secret. Keep it simple. If you need complex spreadsheets and financial models, you don't understand the business well enough. Warren Buffett and Charlie Munger do back of the envelope valuations. It needs to be obvious. Look at the free cash flow. Does it have more cash than it needs to pay all its bills by the end of the year? If that number is growing constantly and the price is reasonable compared to the cash flow, you might have something. Compare the book value to its competitors and look at the historical valuation ranges, because here's the most important part. Margin of safety. You want to buy at a significant discount to what you think it's worth. Warren Buffett's mentor, Benjamin Graham, taught this principle above all others. Why? Because you might be wrong. The economy might turn. Unexpected things happen. By buying with a margin of safety, say 30 to 50% off what you actually think it's worth, you protect from those mistakes and bad luck. Howard Marks explains it with a perfect example. In 2000, internet stocks, everyone was willing to pay any price. In the early 70s, the Nifty 50 traded at 80 times earnings. They were great businesses, but terrible investments. Why? Because people paid too much. Even 20 years later, many of those stocks hadn't got to their bubble prices. Meanwhile, junk bonds that everyone hated sold at massive discounts, and Howard Marks bought them. Anyone that invested $10,000 in 1979 in those junk bonds, by 2000 had made $23,000, and they were never in the red. The lesson, price is what you pay, value is what you get. Never forget it. Okay, you've done the work. You know where to hunt, you've filtered out the weak prey, you've studied the business deeply, and you've calculated what it's worth. Now comes the moment of truth. Do you strike or track? This is step 5, and this is where most investors fail. Step 5 is strike or track. This is your investment decision and portfolio management. Here's what you ask yourself. First, is this better than what I already own? If you already own 10 businesses and this is the 11th best idea, don't buy it. Stay focused on your best opportunities. Buffett says you don't need to swing at every pitch. In fact, being selective improves results. Second, am I willing to hold on to this for 5 years? If you're not, you're speculating, not investing. And apex predators have patience. Third, do I have enough conviction to make this a meaningful purchase? Joel Greenblatt concentrated his portfolio in his best ideas. So did Peter Lynch, and so did Warren Buffett. Charlie Munger says it directly. Diversification is for the know-nothing investor. It's not for the professional. If you've done your homework and you have conviction, size the position appropriately. If you're not ready to strike, that's fine. Track it. Keep an eye on it, wait for a better price. The market goes up and down, opportunities come back around, patience is rewarded. Allan Mecham, who averaged 30% a year over 8 years, says, the average stock price fluctuates by roughly 80% when comparing 52-week high to 52-week low. Certainly the underlying value of a business doesn't fluctuate that much on an annual basis. So the public markets are a fantastic arena to buy businesses if you can sit still without growing tired of sitting still. This is the discipline that separates apex predators from prey. Most investors feel like they need to be doing something, buying, selling, trading, but overactivity kills returns. Every time you trade, you pay fees, you pay taxes. These costs compound over time. Warren Buffett's favorite holding period? Forever. Why? If you've found a great business and bought it at a reasonable price, time is your friend. Howard Marks says, margin of error is a critical element in defensive investing. My third favorite adage is never forget the 6-foot-tall man who drowned crossing the stream that was 5 feet deep on average. Margin of error gives you staying power and gets you through the low spots. By being selective, patient, and disciplined, you maintain high standards. You only strike when you have a margin of safety, and that is how you transform from Wall Street's prey into an apex predator. So let me recap what you've learnt today. You now know the 5-step system that Warren Buffett, Peter Lynch, and Joel Greenblatt have used to consistently beat the market. I call it the 5S framework. Step 1, scout for prey. Hunt where others won't. Step 2, separate from the group. Filter with those 3 M's. Step 3, stalk the prey. Do that deep homework. Step 4, size them up. Value with a margin of safety. Step 5, strike or track. Be selective and patient. Here's what most people won't tell you. This system only works if you use it. Knowing these steps won't make you money. Applying it will. So start small. Pick a company that you're interested in. Run it through these 5 steps. Get the reps in. 7 years ago, I was exactly where you are. Scared, confused, without a clear path forward. But I refused to accept mediocrity. And I refused to believe that I need to be born rich to be wealthy. And that decision changed my life. By the way, don't forget, if you want to learn how to do this for free, click the link in the description and join that 7-day stock investing challenge. Wall Street wants you to stay prey, confused and reliant on their advice. But now you have the same hunting system that the greatest investors of all time have used. So here's my question to you. Will you use it, or will you let fear keep you stuck? If this video helped you see investing differently, let me know by clicking like and subscribing. I drop a new video each week showing you how to invest like the pros. And comment below, which step gave you the most insight? I read every comment. Now that you know the 5-step hunting system, you need to know when apex predators hunt the most aggressively. Stock market crashes. While everyone else panics and becomes prey, apex predators see this as their greatest opportunity to strike. Warren Buffett has used every crash for decades to get richer. In my next video, I break down the 7-step system he uses to prepare and profit from the crash. Click the video on screen to watch it, because knowing how to hunt is one thing, but knowing when to hunt the most aggressively, that's when you separate from the herd forever. I'll see you in the next video. Happy hunting. Cheers, boys.